Hello, Jason Bass here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest cost, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Well, welcome to February 2023, where we've seen the first really serious leap higher in rates since October. At the beginning of the month, the average 30-year fixed was around 6%. Now, it's closer to 7%. This rate volatility needs to stop, please. This comes as a surprise to some, considering the widespread media coverage of the Freddie Mac Weekly Rate Survey, which reported a modest jump from 6.12 to 6.32 this week. Freddie isn't wrong, but the data is now stale. Due to its methodology, Freddie's survey is essentially a measure of this past Monday's rates versus the previous Monday, but not reported until Thursday. Thus, any additional movement throughout the week goes unreported until the following week. In addition to being stale, the survey rate includes a certain amount of additional upfront closing costs known as points. Now, understandably, it's easy for those costs to get lost in the shuffle if you're reading the headlines. By the time you account for the additional upfront costs and the remaining days of the week, the average lender is actually closer to 6.8%. But I'm not the average lender, so feel free to reach out to me for a tailored quote specific to your needs. February's abrupt rate spike has been driven by economic data. It began with the jobs report on February 3rd, but continued with this week's Consumer Price Index, the most impactful inflation report. Financial markets see this data having an impact on the Fed's rate hike outlook. Whereas the Fed was previously seeing cutting rates as early as September, markets now expect the Fed to keep rates high through the end of the year. I tend to agree, depending on, of course, on the geopolitical threats, and there are a few. The following chart shows the September rate outlook rising in line with June's rate outlook, whereas traders had seen September's rate being lower until early February. Now, let's take a closer look at this week's key contributor to the upward pressure, CPI. The Fed would prefer to see the core CPI at 2%, and the core CPI is definitely not anywhere close to 2%. Keep in mind, the PPI number also came in hotter than expected this week at 0.5%. Here are some cliff notes. The PPI, Producers Price Index, is a leading indicator to the CPI, as the PPI measures what servicers or wholesalers are paying for goods that are then put on the shelf for you and I to consume and to purchase. Markets look at the PPI number to get an indication of where CPI might be heading in the future. This is why I believe the markets are betting on the Fed keeping the overnight rate higher for longer, because until the PPI number shows signs of easing, why would the CPI be any different? Looking at the previous chart, you might think that the CPI is falling, and if it continues to fall, perhaps we could foresee a return to 2%. Markets understand it will take time for the annual numbers to fall. That's why monthly numbers are more important these days, and unfortunately, the monthly numbers remained elevated in this week's data. The previous chart shows some promise with monthly CPI, certainly not as high as it had been. On the other hand, it ticked higher from last month and has yet to move below the 0.3% for well over a year. Some simple math tells me a monthly reading of 0.3% would put annual inflation at 3.6%, which is still way too high for the Fed to consider cutting rates. If core CPI were to be operating in the, say, 0.1 to 0.2% range for several months, mortgage rates would have a much easier time calming down and moving back into the 5% range. Away from the inflation front, other economic data continues sending mixed signals. The second biggest report of the week ended up working against rates as well. Retail sales had been in negative territory for a few months, but surged up to 3% in January. While inflation may indeed fall in line in the coming months, and while economic data may increasingly show the restrictive effects of higher interest rates, until those changes are more apparent in the data, rates will have a hard time moving too much lower. The Fed's approach to its rate-setting policy is also an important ingredient in the outlook. Several Fed members speculated that the pace of rate hikes could increase back to 0.5% per Fed meeting. That would be significant, as the Fed just downshifted to 0.25% rate hikes at the last meeting and had been fairly unified in communicating that 0.25% would be appropriate pace going forward. We'll hear a bit more from the Fed this week. Markets will be interested to see how much debate there had been about downshifting to 0.25% rate hikes. Traders will also tune into various Fed speeches throughout the week to see if the next meeting is at risk of seeing a bigger rate hike. And so there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.